January 12th, 2026, and a quiet unease has settled over the financial markets. The pre-market hours are ticking by, but they carry a distinct chill, signaling a potentially turbulent open for the major indices. S&P 500 futures are already down a hefty 0.5%, with the Dow dropping nearly 0.75%, and the tech-heavy NASDAQ 100 seeing losses of up to 0.8%. It's a clear signal. Investors are feeling a strong pull towards risk aversion.
At the heart of this market tremor lies a profound concern over the independence of the Federal Reserve. Reports, first surfacing from Bloomberg and Yahoo Finance, paint a picture of escalating pressure. We're seeing news of a Justice Department criminal probe reportedly launched into Chair Jerome Powell himself. This development, coupled with a barrage of threats from the Trump administration, including demands for rate cuts and even the specter of subpoenas, is casting a long shadow. The fear is palpable. This could be an erosion of the Fed's crucial autonomy, undermining confidence in the very stability of our monetary policy.
This isn't just about the Fed's independence, though. The administration's influence is reaching into other critical corners of the economy. Take, for instance, President Trump's recent demands concerning credit card interest rates. He's made it explicitly clear, threatening legal action against lenders if they don't cap rates at 10% by January 20th. This has sent shockwaves through the financial sector. Giants like Capital One are reeling, down 8 to 10% in pre-market trading, while American Express has seen its shares fall around 4%. As CNBC and Yahoo Finance report, this kind of direct intervention creates immense uncertainty, especially with bank earnings season just around the corner. It's a bearish outlook for financials, and it's certainly dragging down the broader market.
Beyond these domestic pressures, the global stage offers little comfort. Longer-dated Treasury yields are climbing, another reflection of the anxiety surrounding the Fed. Meanwhile, oil prices have found a temporary stability, hovering around $58 to $59 a barrel, while the dollar itself continues to slip. Reuters and Bloomberg note that there isn't any major economic data due for release today, but upcoming auctions and scheduled FOMC speeches mean investors remain on high alert. And we can't forget the lingering geopolitical tremors from Venezuela. Lingering threats to block certain energy firms are still causing uneven performances across the sector, with ExxonMobil, according to CNBC, seeing minor drag in pre-market trading.
The overall sentiment right now is distinctly bearish. Institutional investors are deeply concerned about the attacks on Fed independence and policy interference. While retail investor mood on platforms like X appears mixed, it's certainly tilted towards caution. Even with the VIX, a measure of market volatility, sitting moderately around the 15 range, it suggests an elevated, though not extreme, level of fear. What we're witnessing is a definite shift, moving away from the recent optimism towards a much more neutral to bearish outlook.
So, what are we watching as the day unfolds? The financial sector, of course. Companies like Capital One, American Express, and JP Morgan are taking heavy hits due to the rate cap threats. We'll be looking for signs of further downside or perhaps even some bargain hunting. Energy stocks, especially Exxon, are under pressure from those Venezuela-related comments, so monitoring oil price stability will be key. And given the weakness in futures, big tech and NASDAQ names could face continued pressure, hinting at a potential rotation if this risk-off sentiment persists. This confluence of events means rising Treasury yields could continue to weigh heavily on growth stocks across the board.
If this episode helped you understand today's market turmoil, consider sharing it with someone else.